Equity. An equity is a provision of capital to a firm invested directly or indirectly in return for total or partial ownership of that firm, and where the equity investor may assume some management control of the firm and may share the firm's profits. These are financial instruments that represent or provide evidence on ownership rights of the holders over enterprises or organizations. Normally, these instruments entitle the holders both of distributed profits of enterprises and the residual value of the assets in the event of liquidation. Equity finance occurs when firms exchange share capital in return for liquidity. This can include venture or risk capital and early stage, seed and startup funding. Equity finance is much less common and is typically associated with very innovative and high-tech firms that are often unable to obtain funding from banks. Given the unproven business models of new enterprises, these investments are often needed to pursue strategic developments, complementary technology, or new opportunities for the firm. Targeted enterprises are generally high-tech or pursuing innovative products or services with expensive R&D projects. Mature companies with proven business models may need equity investment to fund new projects, including the penetration of new markets. The return depends on the growth and profitability of the business and is earned when the investor sells its share to another investor or through an exit, such as an initial public offering or trade sale, sale to another venture capital, or sale to a financial institution. There is fully insolvency risk for the invested capital in the target companies. However, this can be mitigated by portfolio investing and by having private sector co-investors. The rationale behind more risk investments is the expectation of higher than average returns. These investments can be time-consuming and cost-intensive. Due diligence is carried out for several potential business plans before investment. Typically, there are few target firms and large amount in each transaction. So, to recap, pros. There are higher potential returns compared to pure debt instruments. There is an active role in project management and access to shareholder information for the investor. Stimulates investment by local private equity industry, also in riskier areas not previously serviced. The need for equity investment might prompt changes in regulatory framework to encourage a private equity market. The company can benefit from investors' management expertise. Public investors can influence the configuration of mission of a company. Cons. There is insolvency risk for all the invested capital. Time-consuming and cost-intensive investment. These investments are more difficult to administer than normal loans. High setup and operational costs. More time-consuming and cost-intensive. Short-term financing is not possible since returns are feasible only in the long term. Establishing the process for the investment can be challenging. Compared to debt instruments, equity can be less attractive to final recipients due to the obligation to yield control. Quasi-equity. A quasi-equity is a type of financing that ranks between equity and debt, according to the exposure to loss in the event of insolvency or the level of ownership acquired. The different forms of quasi-equity, also known as mezzanine capital or mezzanine finance, are classified as closer to equity or debt capital according to the level of ownership acquired and the exposure to loss in the event of insolvency. They can be structured as debt, typically unsecured and subordinated, and in some cases convertible into equity, or as preferred equity, having a higher risk than senior debt and a lower risk than common equity. The risk profile will also change with the duration of capital commitment and the remuneration conditions. Some types of quasi-equity are: subordinated loans have a lower repayment priority than normal loans. In the event of default, all other lenders are repaid before the holders of subordinated loans. Since the interest payments as well as the capital repayments are subordinated, the risk of loss in the event of default is substantially higher than for senior loans, so interest rates are higher to cover the higher risks. Convertible bonds are debt, where the initial investment is structured as a debt claim, earning interest. At the discretion of the investor, the debt can be converted into equity at a predetermined conversion rate. Because convertibles can be changed into shares, they have lower interest rates. Preferred stocks are stocks that entitle the holders to a fixed-rate dividend, paid before any dividend is distributed to holders of ordinary shares. Holders of preferred stock also rank higher than ordinary shareholders in receiving proceeds from the liquidation of assets if a company is wound up. In general, quasi-equity investments are more difficult to manage than classic debt instruments, loans and guarantees. Let's analyze pros and cons also for quasi-equity. Pros. For co-investors, there are higher returns compared to pure debt instruments. Addresses specific risk capacity constraints in a particular market segment. Stimulates investment by local private equity industry, also in riskier areas not previously serviced. Might prompt changes in the regulatory framework to encourage a private equity market. Cons. These investments are more difficult to administer than normal loans, high setup and operational costs, more time-consuming and cost more. Short-term financing is not possible since returns are feasible only in the long term. Any ancillary services, such as management expertise, will be an expense for the company. There are typically a low number of investors and final recipients, while the investment amounts are high. Compared to debt instruments, they may be less attractive to final recipients, as they may involve loss of control when bonds are converted into equity. And this is all for this 5th video of the finMED capacity building tool. I invite you to continue the training with the video number 6. For more information about finMED project and its capacity building tool, please visit the project website, in which you can find much more information, documents, news, and also links to the Interreg-Med program.